What's going on, guys? Yesterday, a bank with more than 100 billion in deposits was murdered by politicians because it dared to service the crypto industry. Yeah, today we are talking about Signature Bank, a bank that was closed yesterday as part of a larger announcement. So obviously what's been going on for the last few days is that everyone has been running around trying to figure out what was going to happen in the wake and the fallout of Silicon Valley Bank. On Friday, California regulators closed Silicon Valley Bank after a big bank run. FDIC stepped in for receivership, and everyone was trying to figure out, were they going to cover depositors over the $250,000 FDIC limit? The conversation over the course of the weekend on places like Twitter was extremely intense. On the one hand, you had folks on both the left and the far right saying, screw these guys. They made their own bed. Let them lie in it. It doesn't matter if they are small businesses or startups just trying to build things. They shouldn't have chosen that bank, which made obviously bad gambling decisions. And this was a huge variety of people having this perspective. Then on the other side, you had venture capitalists basically saying, if you don't make depositors whole, it's going to undermine confidence in every small and regional bank, and kind of fomenting a larger bank run should the feds not step in, which wasn't super happy to people. But most folks were really kind of debating the clear trade-off here. Either the Fed step in and make sure that depositors are whole, even if they wipe out management and shareholders, and in so doing, shore up confidence in small and regional banks, make it so people who hold their assets in those banks don't feel like they have to go to just the small handful of systemically important banks to be protected, but at the cost of the new moral hazard of the Fed being willing to backstop anyone. Or on the other hand, send a strong statement by not guaranteeing those deposits and saying you can't get away with anything. Banks have to, change their behaviors, but at the risk of everyone just flooding out of regional and small banks. That was the trade-off. Now, ultimately, the Fed decided to make the trade-off with less panic, right? They announced yesterday that they were taking emergency measures to protect all the deposits. They made clear that this was not going to help management and shareholders at all, who were being totally wiped out. They made sure to make clear that this was coming from existing funds to protect and insure banks. This was not a new taxpayer bailout. And they made sure that there was something larger too, that it wasn't just to protect these banks, but the Fed actually decided to launch a new lending facility to try to cover the root issue. Now, for those of you who have been watching my videos, the root issue underlying all of these bank failures has not been the fact that they banked tech or crypto, although those were exacerbating factors. The core problem underlying them is the mismatch between deposits, which are banks' liabilities, which can be recalled on demand, and the loans that banks carried on their books. During the zero interest rate period, banks were forced to have longer duration loans, which matured more slowly because that's the only way that they could get yield. They never intended to sell those loans. However, in the context of the fastest rate hiking cycle in history, those loans are incredibly underwater. Right now, banks in America carry more than $600 billion of unrealized losses because their loans have gotten less valuable in a world where the federal funds rate is 4.5%, and you can get risk-free money that yields over 4.5% compared to the 1% or 1.5% type of mortgage-backed securities or other federal bonds or municipal bonds that they held on their balance sheets. So this new Fed program is designed to shore up that problem by saying that when banks get into liquidity issues, not solvency issues, but liquidity issues, they can borrow from the Fed using those loans as collateral at their full value, the full value of the loans, not sort of the market value if they were to go sell them. This is meant to decrease that selling pressure. So the point here, and this will be an important point, is that the Fed thinks that the underlying issue is big enough that they created a new lending facility just to address it. Now, shoved in to this announcement that Silicon Valley Bank depositors were being made whole and that the Fed was coming to the rescue with this new lending facility was the fact that they were shutting down another bank based on systemic risk. That bank, surprisingly, shockingly even, was the last big bank to service the crypto industry, Signature Bank. Now, Signature Bank is not as tied up in the crypto industry as, for example, Silvergate was. Silvergate had 80 or 90% of its deposits from crypto. Signature has more like 25%. Still, it's an important institution for the crypto industry and one of the last remaining places where crypto industry companies, big crypto companies, were banking. So the fact that it was being taken out of commission preemptively before a bank run was pretty notable. And when it came to explaining why Signature Bank, of all the other banks out there, all the other impaired banks, not First Republic Bank, which so many people had speculated as the next likely target for a bank run, out of all of the banks out there, why Signature was the one being preemptively shut down before trading, the best logic was that Bloomberg and New York Times could find was that sources inside said that there was a big bank run on Friday that had shored up on Sunday. That was it. That's the entire extent of the argument. The New York Department of Financial Services didn't give any other reason. And the question becomes, what was so different about that bank run versus every other bank, which was impaired and experiencing the same sort of deposits and outflows? Now, this has a lot of people in the crypto industry scratching their heads, but it's not just the crypto industry. On the board of Signature Bank was Barney Frank, who you might recognize his name from the Dodd-Frank Act, which was the overhaul of the banking system that happened in the wake of the global financial crisis. He was surprised by the fact that the feds, or the New York Department of Financial Services specifically, were shutting down Signature. In fact, he said, "I think if we'd been allowed to open tomorrow that we could have continued. We have a solid loan book. We're the biggest lender in New York City under the low-income housing tax credit. I think the bank could have been a going concern." He went farther in later interviews. Nick Carter writes, "Dear God, Barney Frank openly admits that Signature was arbitrarily shuttered despite no insolvency because regulators wanted to kill off the last major pro-crypto bank." This comes from a CNBC article where he says that where Frank says that there was no real objective reason that Signature was seized, and even explicitly said the same thing that I'm saying to you right now. Frank says, "I think part of what happened was that regulators wanted to send a very strong anti-crypto message. We became the poster boy because there was no insolvency based on the fundamentals." This is a huge, huge moment. It is not just a shot across the bow, it's a shot directly at the face from regulators for the crypto industry. This was a political assassination and we're likely to get more information about this over the weeks and months to come. Nick writes, even the FDIC was surprised when it was dropped into their hands. There is huge problems with the precedent, even if you don't like crypto, of a regulator being able to shut down a bank that is not insolvent under the guise of quote unquote systemic risk without any real question or articulation of what that systemic risk means. That is a hugely inherently abusable position to take. And if you don't like crypto and you're watching this just fuming saying I'm getting it all wrong, think about when it's your preferred industry that's being serviced that gets shut down, because that's the precedent that was set here. As you can tell, I am pretty fuming about this. I'm surprised, I'm angry, and it's not just me. The whole crypto industry is up in arms, but unfortunately it is what it is, and we have to move on to the next battle. I think unfortunately there are many battles to come. But anyways, that's the update on Signature. It was a political assassination. Full stop. Thanks, guys. Talk soon.